Hello and welcome to another 30-minute Thursday. My name is Amit. It is 2 p.m. in the beautiful Pacific Northwest. Thursday afternoon, we are once again live on Facebook. Hope everybody's doing great. Hope you're staying healthy. Hope you're staying safe. Hope you're staying sane. Of course, things seem to be really insane. And before we go too far into what's going on with the state of the economy, with what's happening in real estate and in mortgage lending, I just want to extend my deepest condolences and sympathies and sadness to all the lives that have been lost and harmed and shattered with what happened in Nashville just earlier this week. Some of y'all may know that I teach self-defense. I joke and say that I close loans and crack bones. That's a catchy little moniker, and I love it, and that's great. I also happen to be a law enforcement instructor, meaning that I have the opportunity to teach self-defense and hand-to-hand tactics to law enforcement officers. And also, because of my work with the community and work with law enforcement in general, I get the and with Krav Maga, which is the self-defense system that I do teach, I have the unique pleasure and privilege and opportunity to help law enforcement officers here in the Seattle area, not Seattle PD, smaller departments. I have the unique opportunity to help them train for what we call active shooter neutralization, which is basically what the law enforcement officers who responded in Nashville did. They entered that school, they ran toward the gunfire, and they ended the threat. Whatever else you believe about guns, about the whole story, whatever else you believe, what they did takes a tremendous amount of training. It takes a tremendous amount of courage. And in stark contrast to what happened in Uvalde, where there were hundreds of law enforcement officers in and around the school, yet none of them did what needed to be done in a timely fashion. And I'm not here to point fingers of blame or anything like that. I'm just here to say that thank goodness that those officers in Tennessee were able to end the threat as quickly as they did and save lives. And for those lives that were lost, a tragedy. I'm shocked and heartbroken by any loss of life. But for me, y'all don't necessarily know what it's all about to teach law enforcement officers, and that's okay. But I'll tell you that to train them to respond to active shooters is one of the highlights, if you would, or you will, of my overall training and my community service. And I'll leave it at that. But if you guys are curious about that or interested in other aspects of what I do when I'm not closing loans, I'm more than happy to share with you guys what I can, of course, and to provide you whatever information and whatever insights I can share. In any event, my prayers to the families of everyone whose life was lost and whose life wasn't lost, but forever changed by the events that happened, not just this past week, but throughout all of these shootings. It's a terrible, terrible thing. Okay, having said all that, I know it's tough for me to change gears from that to now talking about mortgages and interest rates and the economy and real estate, but this is what I do as well. I close loans and I crack bones. So let's move on to something that's a little bit less gut-wrenching, which is what's going on in the real estate world, what's going on in the economy in general. Members of the Federal Reserve Board have been talking to the media, and it's always a dangerous proposition when they talk to the media, but they have been very, very, very on top of it in saying that, look, 2% is the target inflation rate year over year, which means basically that we are somewhere around 4% above that right now. We're at 6%-ish rate of inflation, give or take a couple of percentage points, whatever. So we're way above where we need to be, like 2.5 or 3 times where they claim that they want to see the economy. And the question is, where does 2% come from, right? Like, who pulled that number out of thin air? And I heard something the other day in one of the one of the websites, one of the services that I subscribe to that helps me kind of do my research for my work, someone mentioned, interestingly enough, that it may very well have been Janet Yellen who came up with that number. And that was in the 1990s when she was either a member of one of the governors or one of the board members or somebody else within the Federal Reserve System. She was definitely not the chairperson of the Fed at that time. That was either Ben Bernanke or possibly Alan Greenspan. But there was conversations with the media about like, what is a reasonable year over year sort of rate of inflation? Because things do change, right? I mean, prices do go up for whatever reason. Nothing stays the same, right? We all get older, hopefully. The cost of things go up. That's just part of life. But they asked, like, why 2%? And I think, actually, they asked in this meeting, the media asked her, this would have been like 20 years ago, 18 years ago, what is a realistic rate of increase of cost or inflation year over year? And she came up with 2%. I don't know if that was on the fly, if that was planned, if that was anticipated, but for better or worse, this is where we are now. And that number is kind of stuck in the mind, right? Here we are, 2%. That's what we want to see, or more to the point, that's what we want to limit the rate of inflation to. And we're not there. Clearly, we're not there. And so the question now is, what are we going to do to get there, right? And the Fed continues to raise their short-term interest rates. We've discussed this for a long time now. They've gone over the course of 1 year, one calendar year, that interest rate that the Fed maintains has gone from basically 0 to basically 5%. Most recently, they increased it by 0.25% in last week, right, at their meeting last week. And so now the question is, do they continue? And I think the answer is yes, one more time. Uno más, as they say in Spanish. Yes, I'm still learning my Spanish. I'm still practicing. I think we're going to see in May, the Fed meets every 6 weeks. So it's not a monthly meeting, and the last one was late March. So there won't be one in April, but there will be one in early May. And I think that we're going to see one more 25 basis point, 0.25% rate increase for now. After that, I think they're going to press pause on that, and they're going to hopefully take some time to see what they've done and let it work, let it go through the system and get to a point where we're going to see if it's actually doing the job that it needs to be doing. So one more time, in my opinion, I'm just one guy, and really not even a guy that the Fed consults with, much to my shock and surprise and disappointment. The Fed doesn't call me up and say, hey, what do you think here, buddy? I wish they did. Honestly, I don't, because that's a lot of pressure, and it's a lot of things. It's a damned if you do, damned if you don't kind of situation right now. And the bull is already in the china shop, or the horse has already left the barn, however you want to describe it. So now, to try to get the genie in the bottle, let me throw one more at you, to get that back normal, it's tough now. I mean, we should have been doing this 2 years ago or a year and a half ago. We should have been having these conversations. And so inflation is where it is, and the joke or the statement or the whatever is basically going to be something, where it has been something like, the Fed will continue to raise rates until something breaks. That's kind of what the pundits and the people that are smarter than I am and who study this and watch this and deal with this on a regular basis, that's what they say. The Fed will continue to do whatever it's doing until something breaks. And what does that look like exactly? What I'm going to suggest is until we see seriously higher rates of unemployment. Now, that's not my suggestion. This is the Fed itself saying that unemployment rates are too low, meaning that there's too many people with jobs. And because there are too many people with jobs, they continue to get paid. And because they continue to get paid, and because not only are they getting paid, but they're also getting at a place where to retain these people on the job, or to get them, to convince them to even apply for the job, they were offered things like bonuses, sign-on bonus, stay on board bonus, retention bonus, anything like that. And that is, as the Fed describes it, inflationary. Right? They pay you more money to get you to stay on at your current job, and you take that additional money that you've received and you buy a new TV, or you buy, you go out to restaurants, or you take a trip, or you do whatever it is with that. And that, in the Fed's mentality, increases the cost of things, increases the rate of inflation. So what they'd really want to see, and this is not me guessing, this is the Fed saying so in interviews, what they really want to see is unemployment go up. Because when people start to lose their jobs, what ends up happening is that companies have more, a larger pool of people to select from, to either hire or to replace other employees. But because the economy is sketchy and shaky, there's not as much compensation offered. There's not signing bonuses offered at the higher levels. There's not higher rates of pay, because the employers are going to say to the employment pool, hey, look, jobs are scarce right now. People are cutting back, not opening up. And if you want a job here, this is what we can afford to pay. And they're going to pay less rather than more. And that is, I don't know the exact term, but I would say that is counter-inflation. That's what the Fed thinks, at least, and that's what they've said, and that's what they're planning to do. So they're going to continue to raise rates until something breaks. And that's something, at least part of that something, is the unemployment picture. Now, it doesn't happen overnight. Nothing in our economy happens overnight. It doesn't move quickly. I've said this time and again, and I continue to say this. Our economy is not like a speedboat. It doesn't zip around. It takes time to course correct. It takes time for that small turn of the wheel to actually move the ship in a particular direction. So companies don't start by letting people go. What they start with is by saying, all right, we're not going to hire any more people. Right? That's kind of how it starts. We're not going to expand our hiring. And then they say things like, now we may be cutting back on hours. Now we may be cutting back on pay. Now we might be cutting back on bonuses. Now we might be, not filling in when people quit and they leave vacancies. We're not going to fill those spots. And then eventually they're going to get to that point where they're going to start laying people off. And we're seeing more and more of that in companies, unfortunately. It doesn't matter who loses their job. It's always unfortunate. But we're seeing this in companies that a year ago, 2 years ago, we thought were bulletproof, right? Amazon. Who would have thought that Amazon would be scaling back their operations when 2 years ago they were going gangbusters? Same thing with Microsoft. Same thing with a lot of the high-tech operations that happen to be located, situated, or at least have a huge footprint here in Western Washington. So that's happening. And that's going to continue to happen. And as it does, it's going to trickle through to other places, because these people that work at Amazon or Google or Microsoft or whatever it is, they're high earners. And when you earn a lot of money at your job, you are allowed to, or I mean, you're in a position to, I would say, where you can spend a lot of money, right? You can take bigger vacations, you can buy newer cars or electronics or whatever it is. When you're not working, you're not going to be spending that much money, right? You're going to be holding on to your cash because you want to get another job before you start, again, before you become comfortable spending more money. And that, again, is part of what the Fed's big plan is. It's hard to imagine that this is actually the plan, but it is. And that's what they're doing. Now, tomorrow is a really big day in the economy, because it is the release of the February Personal Consumption Expenditures Report. And the PCE is the Fed's favorite measure of inflation. PCE is similar in many ways to the CPI, the Consumer Price Index. It's basically looks at the change in cost across a variety of different sectors of the economy, change in consumer costs. So changes in, let's see here, in rent and the cost of shelter. That's been a really big one. Changes in travel and hospitality, changes in clothing and consumer goods, changes in televisions and electronic goods or durable goods, changes in the costs of healthcare. It measures all of these things, and it gives different weight or different value to each of these sectors. And then they add it all up, and then you get your monthly print. And then they take that month's print, which would be February of 2023, and they go another 11 months back and add all those prints together. That's your year over year personal consumption expenditure change. And hopefully that number is going to keep coming down, right? Hopefully that number is going to keep coming down. And the expectation is it will, but it's not coming down fast enough. And it's not coming down at a velocity that is making the economists and the Fed and the market watchers confident that it's really happening quickly. And so the Fed may very well take that as a sign that they're going to crank it up a little bit more and increase the rates again in May. By the way, in May, we are expecting to see the PCE and that's personal consumption expenditures, and the CPI, Consumer Price Index. We're expecting to see those numbers really start to come down starting in May. And I'll talk about that more later on at future broadcasts, but there is a light at the end of the tunnel, and hopefully it's not an oncoming train. But in the meantime, despite all of this weirdness, despite all of this mixed messaging from the Fed and from the economy and what's going on with inflation and what's going on with interest rates on mortgages, we here, at least in the Pacific Northwest, are seeing an increase in activity, home buying activity. And it's very, very strange. I mean, I expect it. Look, I'm not shocked by it, but it's weird because at the same time, these market systems or analysts or services like Case Shiller, which we've spoken about in the past, they do the gold standard definitive sort of analysis of what home values are in any given market. Like they take the top 20 cities in the United States, of which Seattle is one. And they also do like an overall state of appreciation or depreciation in the housing market in the United States. Well, the Seattle market is showing a 5% roughly decrease in values, according to Case Shiller, 1 year over the other. Now, here's the thing. That's 5% down from the peak, right? It's not 5% down from when people bought their homes necessarily, although it could be. Some people may have bought at the top, and that happens sometimes, but it's 5% down from the peak. Well, in 2020 and 2021, Seattle real estate appreciated by about 40%, some crazy number. So 5% down from 40 means that you've still seen a 35% appreciation of value if you bought your home prior to those 2 years. That's a huge amount. It's massive amount. And so, yeah, there's some alignment or realignment in values and home prices. But what I have experienced with my own clients who are writing offers and trying to buy homes, and in talking with my referral partners, great real estate partners who represent both buyers as well as sellers, is that we're seeing greater and greater occurrences and instances of multiple offers, competing offers. Now, this is really weird to me, and I'm making some sense of it along the way. If you price your house right, when you take it to the market and you try to sell it, you're going to attract a lot of interest. And the psychology is interesting. I'm not saying that you're pricing it below what you paid for it. I'm not saying that you're losing money on it when you sell it. I'm just saying that you're pricing it below necessarily, perhaps, the tippy top of what it could be worth or should be worth. So you're pricing it a little bit lower than that. And that is attracting a ton of buyers who are willing to go above the tippy top and offer you more money than what you're asking for in order to get your house. That's not happening on every house. It's not happening. There are some homes that are taking longer to sell, couple, 3 months on the market. Very, very odd. But the ones that are priced right, that are located in the right place, that are brought to the market in a condition that's ready to sell, they're going fast. We are seeing, again, multiple offers. We are seeing, again, escalation clauses, meaning that, hey, I'm willing to pay $500,000 for this house right now, but if somebody comes in with a higher offer, I'm willing to pay up to $550,000, going up in $10,000 increments, up to $550,000. That's what an escalation clause is. I'm seeing, and I'm hearing this from my own clients as well as from my referral partners, that buyers are waiving their inspection contingencies, meaning that we're back to the days of buying a home without inspecting it. I am seeing and being asked by my own clients, hey, can we waive the financing contingency? Meaning our earnest money, our good faith money becomes non-refundable the moment the seller accepts that offer. So we've already got risk in the game. We're already risking our cash, and we can't get it back if for some reason we don't finance the home purchase. That's happening now. Again, in light of interest rates in the mid 6% to high to low 7% range, it's still happening. It's still happening despite the fact that the Fed hasn't gotten its arms around inflation. It's still happening despite the fact that Case Shiller just said that Seattle home values came down by 5% from last year to this year. All that, it's still happening despite companies like Microsoft, Amazon, and Google suggesting, or not suggesting, saying that they're laying people off, actually doing it, laying people off, and it's still happening. So where do we go from here? What's going on? And I've said it before, I'm going to say it again, I'm going to continue to say it. This is a demographic issue. This is a matter of age. It's a matter of demographics, and demographics dictate the demand. And I will explain in the 8 minutes or so that we've got here. I'm going to continue to explain what I'm talking about because it's really, really, really important. If we have currently, we're somewhere around 3.5%, maybe 3.4, 3.6% unemployment rate. That's really low. If we have 5% unemployment rate, that still means that 95% of people are employed. That is, it's not good if you're one of the unemployed people. I totally get that. And I don't mean to make light of anybody's situation, but there's an old joke, quote unquote joke. When your neighbor loses their job, it's a recession. When you lose your job, it's a depression, right? That's kind of the way we look at things. But honestly, if you have a 5% unemployment rate, that still means that 95% of people are employed. And those 95% of people, many of them, most of them are millennials. Why do I say most of them are millennials? Because the older people, the baby boomers, many of them are already retired, right? That's the gray wave. That's the people that are retiring. 10,000 people a month or a day, or I think it's a day, 10,000 people a day in the boomer generation are getting to that magic age where they're allowed or can retire and get their Social Security benefits and start drawing down on their 401ks and IRAs, 10,000 people a day. I'm not saying that they're doing it, not necessarily in that number, but it's a lot of people that are starting to exit the workforce from that generation, but you've got a ton more people who are millennials who are in the workforce. And guess what? Millennials are somewhere between the ages of 26 and 40. That's part of that's their demographic. They were born, I'm going to do the math on the fly here, which is never a good thing for me. So let me just take a step back and not calculate when they were born, but you millennials, you know when you were born. It's between 1981 and 1995, basically. And guess what? That puts them very squarely in the age of the employment center, and it also puts them very squarely in the age of when they need to, when they are starting a family. And it's that family formation demographic that is driving, that always drives the demand for residential real estate. So regardless of what Case Shiller says about home values in and around the US and in the Seattle market, regardless of the fact that Amazon is laying people off, and we thought 2 years ago they were untouchable, bulletproof, whatever it is, regardless of the fact that interest rates are in the mid 6s to low 7% rate for a 30-year fixed, regardless of the fact that the Fed still hasn't gotten its act together on inflation. When you have kids on the way and you do not have enough rooms for them in your home, you're going to have to make a change. And the people that are in this age demographic that tend to have kids, it isn't the boomers and it's not even the Gen Xers, right? I mean, yes, it's possible, but not likely, and not a massive number of people in that cohort. The people who are in that cohort that are doing that are people in the mid to late 20s to early 30s. And that is the millennial generation, of whom there are tens of millions of people. And those tens of millions of people, they need a place to live. It's just that simple. And so all of these other things that are causing disruptions and that are hard to understand because they seem to be going in opposite directions, understand that as long as there are these millennial buyers out there who need a new home, there's going to be demand for homes. It's just that simple. And so this is what we're dealing with. Now, the homes that are priced right, that are brought to the market, ready to sell, that are in the right neighborhoods, that are in good shape, those things are going fast. They're going fast, and they're going with multiple potential buyers offering to purchase that home. So that is the foundation. Now, here's the crazy part. Soon, I don't know if it's like next month, probably not next month, maybe in 5 months, maybe in 3 months, maybe in 10 months, maybe in 20 months, but somewhere in that time frame, this inflation is going to be brought into control. And when it does, interest rates on mortgages are going to come way down. And every one of the people that is now sitting on their hands, and there's a lot of them that are still sitting on the sidelines. There's a lot that are coming back to the market, but there are a ton of people who are sitting on the sidelines. When this interest rate comes back down and it starts with a 5 again, they're jumping in with both feet. I guarantee it. I will bet you dollars to donuts that more and more buyers are going to come into this market when interest rates start with a 5 again. And when that happens, the competition is going to be fierce, because there are tens of millions of people in the millennial generation, and they saw with their own eyes what happened earlier this year and last year, and what's happening right now with interest rates in the 6s or 7s. And when they say, wow, I could get something for 5.5% on a 30-year fixed, sold, I want it. And they're coming, and it's coming. So my advice to you guys remains, I'm consistent if nothing else. My advice is this: if you are ready to buy a house, buy it now. Get into this market sooner rather than later, because interest rates will come down. We will refinance you. My company, New American Funding, is offering a pledge that if you buy your home and refinance it later, that we will pay your lender fees and $500 towards your appraisal. So that's about $2,000 of credit, or $2,000 of cost you'll not have to spend later on when you refinance with me after you buy your house. But right now, today, this moment is the best time to buy a house for these reasons, because eventually the interest rates will come back down. And when they do, everyone else is coming back into this market, and there will be a lot of people coming. So despite the fact that it feels weird, despite the fact that it feels a little disjointed and a bit schizophrenic between interest rates where they are, the Fed where it is, unemployment where they want it to be, I'm telling you, buy the house now, because this is your best opportunity to negotiate a deal. And that window of opportunity is closing quickly. And it would be a shame to miss out on being able to get the home that you want at a price that is more reasonable than what you're going to pay for it next year or the year after, assuming you can even find the home that you want once everybody else comes back in. So with that in mind, we're at 2:30. I can't believe how quickly things happen. I want to wish you all a wonderful day, a fantastic weekend. Again, our deepest condolences and sympathies to the people lost in Tennessee and to all of these violent acts. It's a terrible thing. I am available to answer any questions that y'all have about the economy, about mortgage interest rates, about buying or selling real estate, about how to be competitive in this market. And if you want to talk about self-defense and active shooter neutralization and things like that, yes, that is something that I also do and can also talk about on the side. Until then, I wish you all a wonderful weekend. I hope you stay safe, stay healthy, stay sane. Thank you so much for spending a little bit of time with me yet again. Have a great weekend, and I will see you next Thursday. Y'all take care. Bye-bye.